Hello and welcome to the What the Finance podcast, where we talk to experts about all things finance. If you get value out of this episode, please subscribe so you don't miss out on any in the future. I hope you enjoy. So, John, thanks for joining the podcast to talk about your recent book, Digital Assets: Your Guide to Investing and Trading in the New Crypto Market. So, I'd like to ask, what was your motivation for writing the book?
Yeah, so I think I've had the motivation for the book was down to timing and two kind of reasons. It was timing of where the market was, the crypto market, where I thought it was, and also timing on a personal level. So if you think about, like, I started writing the book in July 2020, and at that time, Bitcoin was at about $10,000. We'd just gone into lockdown, or we were coming out of lockdown, but the pattern was that we'd be in lockdowns, that there'd be more money printing going on. So there was really a catalyst for Bitcoin to potentially go into a bull run. And if it ever was going to go into a bull run, that was the time. Now, obviously, I didn't know that would happen, but my gut feeling said that this is a good time, potentially, as long as it can hold the $10,000 level. It's a good time to write a book about this topic, because also, obviously, with more interest in a bull market, you get more interest in the market, and it's a business decision. It's obviously good to write a book that's going to reach a target audience at the right time. But also, I wanted to write a book that people could read, that could really help them manage risk in this market, and it's extremely volatile, as you can see today for anyone who's just looked at it in the chart. So I really hope that's been fulfilled. I guess so. The timing of when I started writing it was bang on, but then I actually ended up, books take a lot of time to write. So after 10 months or so, it was April the 12th, and that's when I actually released the book, which incidentally was 2 days before Coinbase went public, and 2 days before Bitcoin topped at $65,000. So that the timing in that sense wasn't perfect, but at the same time, the book's a lot more. It's not just about buying Bitcoin and hoping it goes to the moon so you can get rich. It's about managing risk in all different kinds of market conditions and protecting the downside and being sensible, basically. So I really do hope that people that got the book early on, it might have helped them manage risk a bit more with the downside we've seen lately. So I think in terms of the market timing, and there was also, I guess, the infrastructure of crypto was getting built a lot up at around that time. So you had all these new things. You had custody providers, you had better OTC desks, you had all these different products that institutions could now use to get involved in the market, and you were starting to see a lot more institutional interest in the market. So it did all kind of the stars were aligning for something, and that's also why I kind of got into it. So there's that side. So that's the market stuff, and I can talk a bit about that because it's one of the chapters covers it. But the other thing was on a personal level. Personally, the timing was very good because I just resigned from a position as a partner at a hedge fund, a crypto hedge fund, because I wanted to kind of do my own thing and kind of work on my own schedule. And we just had my wife and I just had our first child, a son, and he's also got his own schedule. So it kind of made sense to focus more on writing a book and other content creation, which is through my blog and things like that. So that was good timing. I think I guess it was my second book that I'd written. Or second crypto book. It was my third book, but the crypto portfolio that I wrote before that, I had a lot of knowledge from a retail side on the crypto market, but because I'd worked in the fund before, I now had all this extra knowledge that I'd learned through the fund. So I was able to kind of, it was good timing in that sense, because I had this knowledge now and I wanted to put it in a book that most people could read and understand and get a sense of how this market's been looked at in an institutional way. Also, I mean, as I've said we were going into lockdowns, or we'd just come out of lockdown. I think in July, I think we were a little bit open, but it didn't look like this would stop. So I didn't see any socializing on the horizon. And obviously I wanted something to focus on, to kind of really fulfill my time as a project, because I think focusing on, books are hard work to write. It takes a long time, but it keeps you focused. It can make you happy too, if you really get involved in it and carry on working on it. So overall, I mean, that's kind of it. It was timing based. It was the motivation really, and whether that's through the market or on a personal level, it was just a good time.
Yeah, awesome. And you mentioned that you were sort of a part of I think it was digital asset hedge fund, Ecstatus Capital. So yeah. How did that really differ? Because of sort of the past finance jobs you had were more into sort of the bulge bracket, big banks. So how did that differ? And then you said you sort of learned the institutional way of trading crypto, and sort of what did you learn from that?
Yeah, I mean, I can't obviously give away too much there,
yeah.
But it's just a completely different thing, because with Ecstatus, a few partners and I started a fund together. So there was a lot less staff, and the whole thing is that you're managing this fund together. So you're working from a much higher level, looking at the whole way the fund runs. Whereas and you don't need a lot of people for a crypto hedge fund, essentially, because you automate strategies. But with a kind of bigger bank, you're a lot more, or an asset management firm, or any bigger financial institution, you're a lot more siloed in what you do. So you're basically just zooming in on one particular role, and you're kind of you're a specialist in that. Whereas I think with the fund, it's a lot more, you've got a few things to manage at the same time. So it was really fun in that way. Yeah.
Yeah, definitely. I can imagine. So we'll go back to Bitcoin. So I know for myself, Bitcoin and crypto, they were actually my first assets that I bought in my investment journey. And I can imagine it's the same for many sort of young individuals, that's sort of how they get into investing, and they have some bad experiences to start with, potentially. So how is trading crypto different to other assets in your perspective?
I just think it's a lot more volatile. Yeah. I mean, like, Bitcoin's supposed to be the most stable asset in crypto, apart from stable coins, obviously. And Bitcoin itself I think it's about as volatile as Tesla, which is extremely volatile. So that's basically it. I mean, you can, there's a lot of variety and there's a lot of different coins. So it's really, there's that sense. So there's the volatility. And then there's also, I guess, the kind of, it's a lot more of a younger market, and there's a lot more, you'll find a lot more people on YouTube talking about it. There's a lot more kind of sides. You'll get people who are always bullish or people who are always bearish. You'll get some people who are just, I guess, in the middle. But yeah, it's an interesting market because it's very easy to get absorbed in this market, and I think there's a lot of interest from retail people and institutions alike. But yeah, I mean, apart from that, I mean, if just technically looking at charts, it trades like any other, like lots of different markets, but obviously it's just more volatile. Yeah. And there's a lot of shenanigans that go on. So yeah.
Yeah, I guess you could sort of link it to sort of AMC and a lot of those other meme stocks and sort of how they trade. Just it's almost like a cult behind them, isn't there? I sort of noticed that.
You'll get some people who are always just bullish, and if you're not bullish on Bitcoin, you're not in the team, and you get a lot of hate on social media and things. So, but yeah, I mean, it's just a chart. If you look at the Bitcoin chart as it is right now, and you just forget that it's Bitcoin, and you just say, well, this is any other chart, I mean, it doesn't look bullish at the moment, but obviously that can change. We just have to see. Yeah,
definitely. I watched one of your other interviews, sorry, and you explained it very well. So you give a real in-depth analysis sort of your strategies you use to trade Bitcoin in book. Can you elaborate on these a bit more?
Yeah, I mean, I guess I don't want to give away too much about what I personally do, but I can say that there's lots of different ways that I've tried different ways to trade Bitcoin and invest in Bitcoin, and there's many different ways that people can approach it. There's a kind of long-term view, and I can go into the charts a bit later, but I think there's a kind of long-term view, which is a very good view, is that you could buy Bitcoin every month and just hold it. And for most average like people who have full-time jobs and they don't have time to look at charts, that's proven to be a very good strategy, because you're basically just dollar cost averaging. And if your thesis is that Bitcoin is going to go up over time because of the fact that it's a finite supplied asset, it's a bit like gold, but it's more suited to the modern age, then, and this could apply to crypto and other cryptos, but just for example, Bitcoin, then just long-term investing, dollar cost averaging is very, very good. And anyone who'd done that, even from the start of the December 2017, when Bitcoin peaked at about 20,000, if you dollar cost averaged in the whole way through the bear market, and that's the true test of doing that, that's the difficulty of it, of course. But if you dollar cost average the whole way through the bear market, anyone who'd done that would have made a lot of money, or would have been up a lot, depending on when they took profits. But so the longer term view is like that. I think it's just like Bitcoin is savings, and that's the simple way. And that's kind of where the book starts in terms of part 2, where it talks about the different ways to trade and invest in Bitcoin. And then it goes on to another strategy, which is called value averaging, which is a bit more aggressive than dollar cost averaging. And value averaging is a bit more like, when the price goes down, you buy more. When it goes down a lot, you buy a lot more. When it goes up, you buy a little bit more. When it goes up a lot, you actually sell some to get back to your kind of intended value. So that goes into that. And then there's obviously, so that's more the investing side. It also looks at just buying and holding from any point in time, and it kind of compares the different results of those. The next thing is, I guess, not everyone would be a person who believes that Bitcoin will just go up. So dollar cost averaging or long-term investing doesn't make sense. Personally, I do think in the long term it will go up. But if you're more kind of, you want to use the volatility and decide, well, it's volatile, as I've said before, how do you profit from that? So it goes a lot into the trading of it. And then there's just technical analysis is something you have to learn and understand. It's not always right, but it gives you a good basis to kind of formulate your opinions. And then the different styles of trading. So you can trade shorter term. So you can be a day trader. It's mentioned in the book, but it's not something I recommend. And then the kind of longer term trading, which is your swing trading, where you trade the swings, maybe range trading. Possibly you can also be a trend trader, so someone who just looks for the bigger trends and gets in the trend until it's ended. So it all depends on what time frame you're trading it. You can trade shorter term time frames, medium, longer term, and obviously the longer you go, the more you're investing, and the shorter you go, the more you're a trader. So all of that combined, I mean, if you're looking at the trading side, it's really about risk management, because technical analysis it can give you some insight into what you think the price is going to do, but it's not always going to be right, and very often it isn't right, especially in crypto where you have big market players doing things. So it's all about risk management, and the whole point is that if you're a trader and you take 10 losses in a row, which any trader can have, if you're losing 1% every single trade, that's okay. You might be 10% down roughly after taking 10 losses in a row, and you'll be able to recover from that. And you're taking small losses, and you might get a big trade, and you might start to be back in the game and be profitable again. But if you're taking like 5% losses every trade, obviously you're really going to kind of lose money very quickly if you take 10 losses in a row. And it's very hard to recover from that. So, I mean, for example, if you lose 50% of your investment portfolio, you don't have to make 50% to get back to break even. You have to make 100%. Yeah. So that's really the kind of basis around what the book's about in terms of the trading side. But then also on the investing side, it talks about the same thing, because don't put all your eggs in the Bitcoin basket. You might be bullish on Bitcoin. You might think it's going to go up to the moon and go to 500,000 like some people are talking about, but what if it doesn't? What if it just keeps going down? So the whole point there is to not put all your money in Bitcoin and put it reasonable portion and that you think is safe. So yeah, I mean, the other things that goes about is options trading. I started writing that chapter and I kind of got a bit like, why have I included this? Because it was quite a complicated chapter, but I just felt, it was the longest chapter that it took me to write, and it was also the longest chapter in the book. But after writing it, I just thought I'd just better include it because it would kind of complete the book, because a lot of people are interested in that.
Yeah, definitely. And I know one of the issues that there's been in options trading is there hasn't been the liquidity on a lot of the marketplaces. Do you think that's sort of it's building up to the point where it is possible to option trade these? Yeah.
I mean, the liquidity with options in crypto, it's not near the levels of obviously regular markets. I think it's just going to take time. I think it's definitely makes a lot of sense, especially for institutions to trade options on crypto. Anything that's volatile, you want options, because that's what options are good for volatile markets. So I think it's just going to take time. Obviously the futures, which is different derivatives, but the futures market is taken off a lot more. But I think options are coming second, but we'll get there,
Yeah, definitely. I think an interesting thing that you mentioned in the book as well is sort of, if you look back at the sort of tech bubble in 2000, you sort of compare it to Bitcoin and what happened, where, obviously a massive rise in price and it crashed, but then there was they started to build up the sort of what was behind it all, and they actually started to build up systems. And you said sort of after the 2018 crash, it sort of a similar thing happened with blockchain as well. So I found that as a really interesting sort of analysis that you did there in the book.
Yeah, thanks. I think that also comes back to the reason for writing the book is you build in a bear market. When the .com crashed in early 2000s, people were building up infrastructure, and the internet was getting built, and all the good companies survived. And it's the same thing, because obviously a lot of capital went in, and some companies got obviously wiped out, but a lot of companies raised a lot of money, and then from there they could employ people and they could build. And the crypto market's very similar, it just runs on obviously much shorter timescales. These cycles are quicker, which is nice if you're more shorter term. So that's really happened. I think in 2017, in the run-up, a lot of money was raised, and you had a lot of publicity of the market, and a lot of, it went into a complete mania phase. And if you're an entrepreneur in that environment, or you're looking to, it's very difficult, I guess, to kind of sit down with your head down and build when your price is just going up. It's very distracting. And I think once we had the correction during the bear market, people could focus on their projects. And there's been two ways that's happened. I mean, first, it's kind of like the projects themselves, the actual crypto projects, but also you've got companies that have built up the pipeline for institutional adoption. So like custody providers, for example. So that's kind of what's happened. People have been building in the bear market, and that's also why we've had this recent surge, because it's now easier to invest in crypto for anyone. For me, for you, for a hedge fund, it's a lot easier than it used to be, and I think that's important. Question is, what's going to happen now? Was that the bull run, and now we're going into a bear market, and more building is going to happen? I think the infrastructure will keep getting built regardless. So to me, that's also long-term bullish.
Yeah, definitely. Well, if you want to do now, if you can bring up the chart, and we can do maybe an analysis of what you think is happening with Bitcoin and other maybe cryptos at the moment.
So, I mean, this is a simple chart. There's not much going on. There's no indicators or anything. It's just a couple of lines, but basically it's showing that you've had this fast downtrend, and the downtrend has slowed down, and now it's potentially slowing down even more. It's also compressing. So what's happened is that when this happens, if you notice now, this range, it used to be wider, it's getting narrower and narrower. Now it's like, well, what happens when Bitcoin kind of breaks this range? I think that'll be the next move. If Bitcoin closes a daily candle below, I mean, this is about 31,000-ish, maybe 31.5, let's say. then it's back in that downtrend. So it's really simple. It's back in that downtrend then, and it's all about closures, because wicks you don't really worry about, because if you look at these wicks, they just get bought back up quickly. So there's obviously buying interest below these levels, but you really want closures below. And then, I mean, if we even wick below that 28, then it's possible to go a lot further down. I mean, 25k probably could get a bounce there because it's a round number, but 20k would be a more appropriate target, because that's kind of the previous all-time high in 2020. On the flip side, though, to go bullish, I mean, you just want to get out of this, and you want this to flatten, potentially turn up. So you want to put in a kind of higher low over here, and then you want to get above that level with a daily close at about 36 to be on the more safer side. And then from there, it's like, well, Bitcoin, it could go up to the top of this range, which is at about 40 to 41. And then you'd have to see what happens over there. But if it broke that, I mean, it could actually go quite high. It could even get to like 51,000, which is kind of the 0.618 Fibonacci retracement level of this major down move. And if it didn't start closing candles above there and holding that as support, then it would still be bearish, because it could easily go up and wick. And it's very normal for an asset to drop and then come up and test like a fib level and then go back down, and it's a bull trap. So it's very hard to be kind of bullish on Bitcoin right now. And as I said, it's just in this range right now. So it's also hard to be bearish for a further downside move. So you really need confirmation. And, you know, I think a lot of people are trading the shorter ranges and getting chopped around quite a lot. So sometimes it's best to just sit on the sidelines, and there's nothing wrong with that. If I go to this chart here, this is a more detailed chart, but it's also on the daily time frame. So yesterday, I did an update on my blog. I just started a YouTube channel, and I was actually leaning quite bullish at the time, provided some certain conditions would be met. And first of all, I wanted this line to hold, which is this kind of upward sloping trend line, and I wanted Bitcoin to start to close a daily candle above this yellow line, which is the 21 exponential moving average. That's not happened. And I said that if we kind of get below this, it's going to likely test the bottom of the range. So we've obviously not held this line. We've broken below it. And now this smaller range, I don't know if you can see if I zoom in, is no longer. And now, I mean, we've got to hold this basically. Will it hold it? We don't know. I mean, it's very possible that it holds it, because you've still got kind of contracting volatility here. If you look at the Bollinger Band, they're getting narrower. So we're still squeezing into this thing. And whatever happens, when we break out of it, it's going to be a big move. It's either going to be up or down, but when it moves, it's going to move pretty quickly. So it's a good time to pay attention. Not necessarily to be trading it, but it's a good time to be paying attention and watching the charts and just kind of sitting there and waiting, you know, if you're looking for a bigger move. So yeah, I mean, I would like to see this 21 EMA, if Bitcoin closed above it, it would flatten, and then it would start to trend upwards. And that would basically mean that the recent price action is starting to trend up relative to previous price action. And we've never really had a positive slope on this since the start over here. And I'd also want to see this 50 EMA, which is the blue line. I would want to see this 21 EMA cross that. And then we could potentially look for a move higher, you know, into kind of above 40,000, perhaps 50,000. But even then, it's like, well, what happens there? Does that mean we're going back into a bull run? You'd have to see. So you'd really want to see, again, daily closures above that level. If you look at this is just something which was interesting, is this relative strength index, which is the relative strength of buyers versus sellers. This has been in a downward trend line since this kind of price pump over here in January. So at the start of the year, for the whole year, basically, for 7 months, it's been in a downtrend. And yesterday, it was actually consolidating just above it. So it was looking pretty good for that we could potentially be squeezing and going up out of this range. But now it's got back below it. So yeah, I mean, it's got to get back above this. I'd like to see above 50 again to show a bit more strength from the buyers versus sellers. And I'd definitely like to see Bitcoin get above that 21 EMA and hold it this time to be looking for a big move. So it's very uncertain. The other thing, which is just, I mean, I guess, I could go into the 4-hour quickly, and you can just see a bit more clearly here that the Bitcoin was in this kind of symmetrical triangle pattern. We didn't have the third touch point on the top. It actually stopped short of that, which wasn't great. So, you kind of would at least have wanted Bitcoin to close above this to look like this is going to break upwards, and then there and then there. But once it lost this trend line, it's dropped quite aggressively. It could be bouncing a bit now, but we just have to see if that gets sold back into. If you went down to 1 hour, you can see a bit more clearly. It kind of dropped. It also dropped below this dotted line, which is the last low, and then it came up. It wicked. It tested that, and that often happens. And this is the 21 hourly exponential average. It tested that, and now it's dropped. It's dropping back down. So we'll have to see what happens there. Going into this is like a common chart. I mean, everyone in crypto looks at this chart, but I think that's also a good reason to look at the chart, because if everyone's looking at the same chart, it's often a self-fulfilling prophecy. And right now, I mean, this is the 21 week exponential moving average, and this is the Bitcoin price since 2012. And whenever we've been trending above it, we've been in a bull market. Whenever we've been trending below it, we've been in a bear market. Except for this time, we actually, in the 2014, we had this double peak cycle. Bitcoin wicked below it, and then it quickly got back above it. And also notice that the slope of this, it didn't go negative, it stayed flat. Whereas here, the slopes turn negative. So that means that the downtrend is it could be accelerating. You've also got a slope that's gone negative here at the 2017, and a slope that's gone negative here. So we could easily bounce. And as I said, we could bounce up here and get above it, just like we've done over here, just like we've done over here. In fact, we did it twice over here and twice over here. But until we can hold that as support, there's no talk of us going back into a bull market again, unfortunately. So that's just a simple way of looking at it. I mean, yeah, and if just to go back on those Fibonacci levels, if we just take this over here, and this is what I was talking about earlier, this is the current, you can see we've tested it. So it's really about getting a closure above this. This will keep changing. But okay, so this is the Fibonacci retracement level. And if you take that from the top to the bottom, all the way down there, you can see that basically we've had this downward move. If we assume this is the bottom, we don't know that was the bottom, that wick, but if that was the bottom wick and Bitcoin suddenly goes up from here, it could get to, the first target would probably be, if it got above this, let's say, it would be 42,400-ish, because that's the first kind of 382 Fibonacci. And then you've got the 0.5, which is 46 around there. And then you've got the 0.618, which is about 51,000. So I would really like us to start closing at least daily candles above that to be confident of a bull run. But again, if we just wick up above it and like tag that level and start to come back down, then it's very likely we get back to the kind of this range again. And then it's like, is there enough strength there to then break the range? So it's very difficult to say what exactly is going to happen. But if you look at the kind of overall picture and just base it on history, you have to be a little bit bearish until proven otherwise on the macro. And in terms of the shorter term time frames, there's just those levels I spoke about. So we just have to be, I guess, closing above 36,000, let's say, on a daily, or closing below 31 on a daily to get out of this kind of squeezing trend range that we're in.
Yeah, definitely. I think you mentioned there it was a daily 21 EMA. So if we get above that, that would be a good sign potentially that we may push further up. I think that was at about 34,500. So you say that would still be the first target if we get above that, and then if we get above 36, and that would be quite a good indicator, and close a daily candle above it.
Yeah, I mean, it depends again. So it always depends on what time frame you're looking at. So if we're looking at a kind of a swing high trade on a daily time frame, then yes, you want to get above the 21 EMA, but you also want to see the slope of this start to flatten and accelerate. So I think given where the way we've dropped, I'd really want to see us get above, yeah, probably about there. So like 35, above 35,000, to look a bit more bullish for a swing trade potentially. 36,000 is obviously a lot of resistance there at that level. That's even better. So obviously, you know, you've got to be either you're conservative or you're aggressive. If you're aggressive, you're looking at lower levels to confirm an uptrend. If you're conservative, you're looking at higher ones. But then obviously the upside of the trade gets lower. So everyone's got their own kind of ways of looking at it. But yeah, I mean, on a daily time frame, that would be the case. Yeah. But yeah, that doesn't mean Bitcoin's going into a bull market again. It just means I get a nice bull trap or a swing high trade.
Yeah, definitely, as you said. It's interesting. So you use levels. So as you said, it's just going level by level by level. And sort of if there's a resistance there or there's things that could prevent it from going up, and just reanalyzing when they get there, basically.
Yeah, I think that's the important thing. I think, you know, it's very hard to predict the market. I mean, no one can predict what's going to happen really. So you really have to you just have to analyze it level by level and see what's happening. One thing I do like to look at is like Bollinger Bands. So if I go into this chart, I can use a 4-hour, for example. Put that in a 4-hour chart. So like, for example, I mean, these things are very good at telling you if the move's about to slow down or carry on. And when you're closing candles kind of outside this Bollinger Band, it means that you're trending in the same direction. But if you start closing candles inside it, that means by definition, the Bollinger Bands are getting closer together. And when they're getting closer together, the trend is losing steam. And that's when you're looking at potential reversals of the trend. But right now, if you look at this, the Bollinger Bands have been kind of close together. Now and this is a 4-hour chart, for example, this doesn't mean anything on the daily. Now they're expanding. And that means that the trend is the volatility is accelerating while the price is going down. So that's obviously a condition that as long as that keeps on happening, you're going to look at that as bearish. But then if you look at like the 1 day, I take the same chart, you've actually seen the Bollinger Bands are getting closer together even now, because it's gone up, gone down, gone up, gone down. So I guess the thing is, if you close a daily candle below here, suddenly these bands are starting to get wider, which means that volatility has gone down and now it's expanding, and you've got a confirmation of price at a certain level, then that's very bearish, because that could mean you could have a big downside move, because if the volatility is going up and the price is going down, the move is going to be bigger. And it's the same thing over here. If you start going up and this starts to get wider while the price is trending above it, you're in a trending move. And I mean, just quite interestingly, you can see this on them. I guess I could go in well, actually forget about it. It's going too deep into it. It's up to, you know, I could talk about this for hours. If I go into the monthly chart and look at the Bollinger Bands, you can see some other things, but we'll leave it there.
Okay, yeah, no problem. Like I could imagine. So if when we look at sort of altcoins as well, do you sort of use Bitcoin as a way to analyze just the trend of the market in general, and then you'd analyze the altcoins, or do you have different ways to analyze those as well?
Yeah, I mean, I basically yeah, I mean, altcoins it's all about what Bitcoin's doing effectively. If Bitcoin is falling out of the sky, altcoins are going to fall harder. If Bitcoin is in a major trending upside move, altcoins are actually usually not going to be keeping up. If Bitcoin is ranging but slightly going up, altcoins will tend to do well. So I think Bitcoin's a very good barometer of what the market's doing. And if you're going to analyze altcoins, then you have to know what Bitcoin's doing, because Bitcoin can just change quickly, and that can crash the whole altcoin market quite quickly. So it's very important to look at Bitcoin. And, you know, it's a large part of the market, and it's the thing that most people are looking at. What's interesting though is at 65K, when Bitcoin was kind of topping out, maybe just go back to this chart. It took so much time to do that. And most people were expecting this blow off top for Bitcoin. But we didn't really get that. We had this slow kind of whack off distribution top. Whereas if you look at the altcoin market, just take like Ethereum, for example.
Yeah, I think there was like an alt season, wasn't there, with Ethereum and Binance and stuff.
But if you take like Ethereum, and let's just assume this is the altcoin market, obviously they're all going to be slightly different, but you had this major like just blow off top effectively. So I think knowing that Bitcoin was slowing down, it was a tricky situation, because when Bitcoin's slowing down and consolidating, especially when it's at these kind of around all-time highs, the altcoins were doing very, very well. But as soon as Bitcoin went down, all those gains went very, very quickly. And I mean, Ethereum, it lost like, I mean, 60% on a candle. Yeah. Or not on one candle, but like on a few. So that's just crazy. And to me, that's quite bearish. I mean, that, like, if I look at Bitcoin, it doesn't look good, but if I look at this, it looks a lot more like a blow off top scenario. And I mean, yeah, I mean, Ethereum's got a lot of work to do too. I mean, if it doesn't kind of go up from here and break this level, which is the 2.8 kind of 3,000 level, I call it, it doesn't look good.
You see further down.
Yeah,
awesome.
There's a lot, and there's not much support. You know, it kind of consolidated here, and then here, it's gone up so quickly. That's the problem. So there's not much support. There's a little bit over here and over here, but
yeah, I think that's the issue when you see sort of these assets, they go up so quickly. There's just no sort of history of price action to act as support or act as a way for it to sort of stop it from crashing almost as quickly as it went up.
Yeah, I mean, it's basically that. It's just like it went up so quickly. It's like gravity. You know, if something goes up too quickly, it's going to come down. So yeah, I mean, it's the same with every other asset. And obviously, if you look at things like the NASDAQ right now, that's going up in a straight line too. It will come crashing down, but it could also keep going up for quite a bit longer. But a lot of that depends on what like the Federal Reserve is going to do, and they may stop their buying assets, stop the QE, or taper it down. So we'll have to see.
You sort of mentioned the importance of risk management before, and it's quite an important part of the book as well. Can you talk more about that and sort of some of the tactics you use, the ones that you can divulge?
Yeah, I mean, I think it's just everyone's going to have different levels of risk. So, you know, you might be someone who's got stable passive income that generates by itself, and you can afford to take more risk on your trades. Or you might be someone who really needs to trade for a living, and in that case, you got to take less risk. So there's lots of ways to manage risk. It's just what kind of risk does someone want to take? And it all comes down to, I guess, a few things. I mean, it's like the time frames. So it's how much do you invest, and it's how long do you invest for? How long are your time frames? And then if you use stop losses, where do you set those? And what is you most willing to lose on a trade? So yeah, I mean, I think there's also another thing which I think I haven't spoken about, which is scaling into trades. So if someone buys all at once, and they go and buy Bitcoin and they put all their money in, and the trade goes wrong, they've lost quite a big amount. But if instead they, let's say, split it into 3 orders, so they do the first order, the trade starts going well, it's in the right direction, they're happy that, you know, as I said, they're following the chart, they're seeing what's happening, then they can add a bit more. And then if it carries on going, they add a bit more. So that's a good way to manage risk, because you're scaling in. You're not just going all in all at once. And it's the same applies to long-term investing, obviously. So shorter-term trading, this can apply, but longer-term investing, it can apply too. Because if you just, like if you go all in on Bitcoin, like let's say today, I decided, you know, I've just come into all this money and I want to buy Bitcoin and I'm going to hold it forever. Okay, that might be great. This might be the bottom, and Bitcoin could go to 300,000 from here, and that would have been an excellent investment. But what if it's not? What if it's actually going to go down to 20, maybe even 10, who knows, and accumulate for a long time and then go back up? In that case, you want to be dollar cost averaging. So investing small sums often rather than a large sum all at once. So that's the same, whether it's trading or investing. It's just trading is on a much more micro scale. And then there's also profit taking, which applies a lot more to trading. You know, if you're in a good trade and you're up, you want to take a little bit off the table and raise your stop loss so that you're in a risk-free trade. Because it can be trading is all about realized profit. It's like if you're in a trade and you haven't taken profits, the trade, you cannot celebrate anything. You're still in the trade, it could still go against you. So raising a stop loss is very important. And then often the strategy is to trail the stop loss higher and higher as the trade goes in your favor. But you've also got to balance that too. So, I mean, it's a complex thing. It's like taking profits is great, but if you take profits too early, you might not be managing risk that well, because you could be a trader who takes small losses all the time, but you rely on big wins to actually be profitable. And if you're taking small losses all the time and then you suddenly get into a profitable trade and you quickly take profits, you've got a small losses followed by one small profit, and that's not going to do anything for you. So a lot of it just depends on the style of trading, and there's no real one size fits all answer. But I think what's important is having a strategy, writing it down, sticking with it, you know, not getting swayed by what you see on Twitter and everything, because everyone's got a different opinion. I mean, I can go on Twitter and I'll see 100 different opinions on what's going to happen. And, you know, you've done your analysis. So it's like, focus on that. And also the other thing is, I think if you do your analysis before you're in a trade, when you're doing that, you're actually in a logical state of mind. You're calm. You're just looking at the chart and you're kind of deciding what your plan of action is. You should write it down. And then when it comes to executing it, that's when you get the emotions come, because obviously now you've been planning this strategy. You've said, if this happens, I'm going to do this. But when push comes to shove, that's when the emotions come in. So it's like, put your orders in advance, or just learn to be disciplined and follow your analysis. I think that's very important, because the biggest reason, I think, well, there's two reasons I think traders lose a lot of money. The first is stop losses, getting hit too many times. And if the stops are too wide, they will be quickly losing their capital, and it's very hard to recover. The second reason is emotions, is trading based on emotions and not having a plan and sticking with the plan, because the markets are quite random. So you've got to have a strategy that is not random in order to get results. Whereas if you've got a random strategy and you're changing it every single time in a random market, based on your emotions and what all the time, it's not going to work, you know. So it just depends on what kind of person you are. Long-term investing is very simple, and most people, that's what they should do. They just buy every month whatever asset they want, get a mix of different assets, a little bit of Bitcoin, a little bit of stocks, gold, whatever, and just keep doing that. Because if you put your money in the bank, which is cash, you're not going to be wealthy when you're older, because there's inflation. Maybe some years you get a bit of deflation, like after the Great Depression happened. And maybe we're going to deflation now because of the lockdowns. But over the long run, cash is losing money every year. So it's risky not to invest. And you've got to kind of, you've got to invest in a way that's sensible over time. If you're going to invest, and if you trade, you've got to manage risk in those other ways.
Yeah, definitely. I think sometimes it's best just to walk away from the screen and just take a few deep breaths. I've been in a few situations like that. I remember in March 2020 when it was just crashing down so quickly. And yeah, it's sometimes best just to walk away, isn't it? Especially if you have a trade on.
Yeah, I think so. I mean, if you've been in if you're in a losing streak, it's like, take some time off, you know, just reassess, and don't revenge trade. That's the worst.
Yeah, there'll always be another trade. I think that's something that I've heard before, and it's so true. You know, even if you miss out on this one, there'll be another one quite soon. Yeah. So you mentioned sort of the influx of institutions into crypto and digital assets throughout the book. Yeah, it still sort of pales in comparison to other assets. So what would you say have been sort of the major barriers to further institutional investment and adoption, and do you see it continuing to grow? Yeah.
So institutional adoption into crypto, it's been very slow over the last, since Bitcoin started, but recently since that bear market, the previous bear market started, there's been a lot more stuff that's been built for institutions to get them into the market and kind of like make it more familiar to them. So it's been accelerating, but recently, obviously with the price, we've seen that. But there's still a lot more hurdles that need to be done for the bigger institutions, as in the guys that are managing retail money, like pension funds and things like that, for them to get involved. But for the smaller institutions, or not necessarily smaller, but for the more, I guess, institutions which have a broader mandate, like hedge funds, family offices, when they can do a lot more, they've got a lot more ability to choose what they want to do and a lot more discretion. There's a lot of on-ramps that have been built for them to make it a lot easier. So, for example, like custody, that's obviously a major thing. If you're an institution, if you're a fund manager and you've got client money in Bitcoin and you've left that money on a crypto exchange and the exchange gets hacked or shut down or something like that, you're in big trouble. And also, you could probably hold the keys yourself as a private key, but what if you lose them, or what if someone takes them from you? You're also in trouble. So you need to have like an independent custodian to look after those assets, and they have that for all different assets, stocks, everything. You always have a custodian. But in Bitcoin, it's always been difficult for institutions to get quality institutional grade custody to safeguard those assets and look after them independently. So that's a major thing for me. I think that's one of the biggest things, which has allowed institutions to hold Bitcoin and crypto as spot, as in actually hold it physically, custody themselves. There's also like OTC brokerage. So institutions are not buying like 5 Bitcoins, they're buying a lot more. So now they can buy it over the counter without using an exchange. So they're not going to move the price as easily. And then there's a whole bunch of other things. You've got like fund administrators who, if you're a fund, you need a fund administrator to calculate your net asset value every day or month. And they need to understand Bitcoin. They need to do like anti-money laundering and KYC if there's Bitcoin involved. So they have to have tools for that. They've got CipherTrace now, which is one thing. There's also banking. And funny enough, when I was writing about banking, how that's improved and getting better for crypto companies, at the time I was writing the book, but actually that looks like it's not great, especially in the UK right now. There are some banks like Signature Bank and Silvergate, which are very pro-crypto, and those banks have been very good and allowed institutions, because you've got to have a bank if you're going to be a company that's going to be involved in crypto even. And then obviously there's all the different products. So a lot of institutions, they just want something that's easy and familiar. They don't necessarily want to get a custodian or anything like that. They just want to have exposure to Bitcoin through some kind of synthetic product or just other product. And you've got all kinds of things. You've got CME futures, which is very normal for an institution to trade CME futures. It's just this happens to be with Bitcoin. You've got exchange traded products, which are not ETFs per se, but they are they're debt securities technically, so they've got a bit of credit risk, but they're something that institutions understand and can use. And then you've got your investment trusts, which grayscales and all things like that, which are just companies that hold the shares. So there's a lot of ways that institutions can get exposure to crypto, and that's kind of allowed them to. And I think this will carry on. There's always going to be big investment in this infrastructure, and so long as that carries on, you've got to be leaning towards more inflows into Bitcoin and crypto over time. It might take a very long time, but if that's going to happen, then the price will would likely trend upwards over time, because there'd be more interest in the market, and the volatility will probably go down because it'll be more like any other asset class. And I think that's the way Bitcoin is headed. Some of the other cryptocurrencies, Ethereum probably, but you don't really know with some of the smaller caps. A lot of them are just very speculative right now, and there's no point in getting too excited just yet. I think until the market kind of turns around, I wouldn't go near the alts too much.
Yeah, and something you mentioned there was that the sort of it'll become less volatile, and probably the trends will start to become longer. So rather than having like really quick, bull runs, few years, and really short bear runs, they might become a bit longer, sort of similar to normal market trends. Is that what you believe?
It's very hard to say what will happen because, I mean, I do think the volatility would decrease because you've got a bigger asset class. If the price goes up, you've got more money in it, which by definition means that you need to take out a lot more money to drop the price. So I think the volatility would go down. I'm not really so sure about, what was the other part? The trend. You're saying getting longer. So I'm not really so sure. I mean, that is possible because that's what other markets have done. But it's very hard to decide that because we've been in this long bull run in equities since basically since 2008. They've been printing a lot of money, the central banks, and stocks have just gone up and up and up. And that's when Bitcoin started. So Bitcoin's only been around in an equity bull market environment. So what happens if we suddenly go into a bear market now? What happens to Bitcoin? Does it actually become a more of a safe haven asset? Does it stay as a risk asset? So it's very hard to say what's going to happen to the trends longer term because a lot of it might depend on what actually is going to happen with stocks. And it's very hard to say, but you know, I've been bearish on stocks for a very long time, but at the same time, I've always recognized that until there's confirmation that there's an end, there's no point in going against the trend. The trend is still your friend. It's still going up. It's very hard you don't want to try time the top because you're not going to do that.
Yeah, definitely. I think so when we've seen the corrections in the market in obviously 2020 and 2018 in equities markets, that's when we've sort of seen a correction and a bit of a bear trend in Bitcoin and other cryptocurrencies as well. So that's interesting. So I've only got a few more questions. So you talk a big part of the book is sort of putting together a crypto portfolio and how to do that. So I know before you talked about sort of being a bit diversified in how you invest. So can you talk a little bit more about that?
Yeah, I mean, I think it's kind of like if you bought Bitcoin at the let's say you bought Bitcoin in 2010 when it was 5 cents or something like that, and you held it all the way to now, you'd be like one of the richest people ever. But to do that would be extremely difficult because during that time, Bitcoin's had like, I don't know how many exactly, but I put it in the book, but it's like 8 corrections that are massively over 50%, and it's had a few that are 80%. So would you have been able to just buy and hold Bitcoin all that time, even if you were super bullish on Bitcoin long term and you really were resolute in that you thought it was going to go up eventually? It's been very difficult for someone to do that, to just hold it through all of those corrections. So diversification, it might not lead to better returns. In fact, it clearly doesn't in the case of Bitcoin, but it will definitely keep you invested longer because it protects you from your emotions. And most people, if something crashes that much, they're gonna have to sit on their hands, literally, because otherwise they're gonna press the sell button. So diversification, it helps in that way with emotions. But also, if you just look at something like Bitcoin, it's volatile. So if you're buying it all the time, let's say you've got like 5%, and that's just a number. That's not investment advice. That's just an example used. You can get good upside on that. But obviously, if you don't rebalance the portfolio, that 5% can turn into 100% or 90%. And then suddenly you've just basically got Bitcoin because the other assets that have not done very well or relative to Bitcoin are now taking up a small part. So the idea is to rebalance in and out of Bitcoin. And that way you're kind of keeping your risk constant. So, you know, if Bitcoin's going down, you're rebalancing out of the other assets that did better. So like stocks, gold, for example, and buying Bitcoin with that, which would have made you buy lower. So it's all about just keeping that balance. And that's a good way to manage risk over time.
Yeah, awesome. And I found that very interesting. And if people wanted to find out more, they can buy the book. So on to my last question. So what is sort of one message you'd like people to take away from your book?
I think it's just invest in something. It doesn't have to be crypto, but just don't save money in your bank account and expect your future to be okay. Just learn how to invest in something and learn how to invest. I think is important, and it doesn't matter what specifically that is.
Yeah, awesome.
Cash, long run, it's not going to work. Maybe in the short term, but not in the long run.
Yeah, definitely. Awesome. So thank you so much for joining the podcast today, John. So if people wanted to sort of find out more about you or buy the book, where would be the best places for that to be?
Okay, so I've got a blog called stopsaving.com. You can look on there. It's got all the details. I recently joined Twitter. I'm quite new. I'm on there at JB Hobbs, which is my name. And the books themselves, if you want to read those, they're on Amazon. You can just search my name, Jonathan Hobbs, or Digital Assets is one book, Crypto Portfolio is another. There's another book on investing in mutual funds, which was the first one I wrote, called Stop Saving, Start Investing. It's quite a good beginner's book. And then, yeah, the book's also on Google, Apple, and other kind of online retailers for the ebook version.
Awesome. I'll put all the links in the description, so don't stress about that. So, yeah, John, thank you so much for joining today to talk about your book.
Thanks very much, Anthony. Cheers.
Cheers.